So today, for anyone who's just joining, we're going to be talking about the VC slowdown, the topic that lots of us return to, and I think many of us feel still are not getting very conclusive answers on, but hopefully we can shed a little bit of light with what Hussein's seeing, what I'm seeing, what the data is telling us today. We're going to be taking questions, so you can just submit them on the Q&A. Hannah, who's my colleague in the background, is going to be helping filter them. You can also like questions if there's one out there that is similar to one you want to ask. If you do that, that makes it easier for me to know what to ask. It's just a short and snappy chat today. We've just got 30 minutes, but I'll try and juice as much intel out of Hussein. We've also, for anyone who has signed up for this but hasn't yet signed up for our Sifted Summit, it's a 2-day event in October 4th and 5th in London. Hussein will also be there. He'll be talking about how you stop your investors from giving up on you. So if you're a startup in hard times, the strategies that you need, so you can sign up to that would be great. But to get into the topic, because we've got about 100 people already here, we're talking about the downturn. As many of you know, deal count and the value of deals is way down. Some new data from PitchBook came out just this week that shows that the UK VC deal value fell almost 60% in the first half of this year compared to the first half of last year, and that's pretty much in line with Europe as a whole. VCs are also taking longer to close their funds. Apparently it's now taking 15 months for VCs to close a fund versus just 9 months in 2022. And in the UK so far, only PitchBook counts 20 funds closed, in comparison to, if I can see my numbers properly, 66 in the whole of last year. So just everything massively slowing down. Hussein, what does all of that mean? Oh, sorry, to properly introduce Hussein, Hussein is the general partner at Hoxton Ventures, which is a London-based firm that invests all over Europe and has many of Europe's most notable tech companies in his portfolio, some notable for having not quite gone the way we all hoped they would, and some for having done very, very well. So a very useful perspective. So yeah, Hussein, VC activity obviously massively slumped. Lots of firms barely seem to be investing at all. What's going to happen? Are we going to see VCs actually disappear, or are we just in a kind of hibernation phase?
It's a good question. I mean, this to me feels a lot like the dot-com bubble and then the burst afterwards. It's nowhere near as bad, but it has many, many similarities. And in the dot-com bubble, you saw a bunch of people raise funds at the peak of the bubble. And then, 5-10 years went by and funds raised a second fund and maybe a third fund, but they never really got to the fourth fund. And they then kind of slowly went out of business. The problem with the venture community is it doesn't die very fast. It takes a long time because these are 10-year funds and the funding cycles are every 3 years. I suspect we saw a lot of people raise money in the pandemic and then post-pandemic and kind of all the euphoria around tech. I don't know if those folks have managed the capital super well and put money to work in the greatest of companies. A bunch of these companies look like they're great companies because of momentum, but the fundamental reality was a little bit different. There's lots of press on this kind of stuff because we see lots of examples on this. I don't know how easy or hard it's going to be for them to raise money and keep the businesses alive. I also think a lot of people right now are sitting out the market. And so I don't think there's a lot of deal activity. I was really surprised by the PitchBook data because I didn't think the magnitude was as high. I thought the rhetoric in the market is it's down, but it's down a little bit, maybe down a medium bit. This is down a lot bit. It's like we're at like 20 to 30% of the volume of where we were. In context, like if you benchmark it against 2017, 2018, we're still on track to be about the same size as 2018, 2019. So if you just kind of ignore the pandemic years, it's actually okay. But the pandemic years were really quite boom years, and so we are considerably down from those boom years. I suspect it's going to take like another 2 to 3 years for this mess to kind of clear up. That it's not like 6 months, it's not 3 months, and it's going to be difficult out there for companies to raise money in the same way it's going to be probably difficult for venture firms to go off and raise money.
Yeah, but we can't, I guess, so there's been a lot of like wait and see, hasn't there? There've been firms that have just massively slowed down because I think people want to see where valuations are going to settle, is my sense. But at some point people have to start investing again, don't they? When will that be, or what will need to happen to force people to start picking up the pace?
Well, there's nothing that says people have to invest. I mean, I think people ought to invest if they have pools of capital, like they have to put those things to work. But you can easily go from in the pandemic we saw a lot of venture funds. Tiger was kind of the most famous for investing everything that they had in under a year, right? So really really fast. Traditional is probably around 3 years. I would say the average move from the traditional 3 years to more of a 2 year period. But you can take that same duration all the way up to 5 years if you wanted to. Most legal documents that kind of govern venture funds say it's usually around 5 years at a maximum. That's when people get irritated. So you can sit out the market for a year. Yeah, if you're investing on a 2 year cadence, you can easily stretch it to 5 years, which means you can be sitting out the market not for like 3 months or 6 months, but you can sit out the market for like 2 years if you wanted to. The other thing that you have to do is the public markets corrected a long time ago, like 2 years ago. So there's not much new data on this valuation side. Like the valuation corrected, kind of public markets moved on. Some of the mega caps kind of went back up a little bit, but generally speaking, the public markets have been pretty stable about SaaS multiples. They're not like 10 times forward multiples or 20 times forward multiples. They're like 6 times forward multiples, 7 times. Historic is like 5 to 6. We're a little bit above historic. But the venture community, I think, has been investing at 20 times, 40 times, 100 times, 200 times, and that makes sense in the wake of growth. But they're waiting, I think, for the SaaS things to come back in the public markets. I don't think the SaaS things are coming back in the public markets. I think kind of the new reality, we level set back and we're kind of stable. And you have to go figure out what to do with all those old companies that you've invested in. So if you invested at 3 times the market average, you've got to wait for the company to grow into that valuation by like a factor of 3, right? The company grows 3 times and is right back to where you were. It has probably grown 6 times. And that's as much as we would love to believe like late stage companies can triple their growth in 1 year. Like it usually takes a couple of years for them to be able to get there, maybe more than a couple of years. So it's a slow process for them to kind of not take write-offs. And people don't want to take write-offs. And I think all the mental energy in the venture community, at least at the late stages, is on the existing portfolio and avoiding taking big write-downs. And then the problem with a lot of these companies is they need more money, right? It's not like you've invested and then they're kind of done and you can just kind of sit back and relax. You've got to figure out how to get these things financed and to not go bust, because they're usually burning cash. And so I think all the energy, not the mental energy, like the actual energy of the business is on fixing those companies. And when that happens, new stuff falls by the sidelines. And I just think that's the industry that we're in. People thought at the beginning of this year, the beginning of last year, that it was going to consume the year and then it was going to go back to normal. There were a lot of people who said, September is going to come around. People will come back from the summer. There'll be business as normal. These are slow changes. Like they're not going to change tomorrow. This is going to be like another year or 2 or 3 before all of this stuff kind of washes out. And it has to wash out before people kind of get a break, from all the energy that's kind of, in order for them to get back to kind of more productive new things.
What does that look like from your perspective, the companies that you're working with, to help them stretch their runway, or figure, if you've got a company that you're like, what, you haven't reached the valuation, you don't merit the valuation we hoped you would by this point, but you need to raise money in X number of months. Like what are the kind of options? What are VCs working on with those kinds of companies behind the scenes? What's this energy going towards?
So I think for the early stage people, because we're not late stage folks, right? So we don't have necessarily the big overhang, but we have this problem is we're very dependent on the late stage folks because we need them to write the checks into our companies. I think almost everyone in the industry now has converged on the same idea. We started it about a year and a half ago, so we're a little bit ahead of the pack in this, is we should just assume that there's no money coming. Like we would love to believe that there will be money coming, but we should assume and work in the condition that it's not going to be easy to go fundraise. And so, you've got to retool your business. You've got to think more about profitability. You got to think more about bridge notes. You got to figure out a way to shore up the balance sheet so that the company has enough money to survive through all of this. If they can survive, we were saying we should survive through 2022 and 2023 and try and get to 2024. I think probably realistically, you need to survive through 2024 and get to 2025. That we still have to work on. Most of our companies are fine until 2024 sometime, but they're not quite there into 2025 territory. But you just have to assume that this market is not going to error correct itself. And then, to the extent that you can raise money, like a couple of our companies have raised money recently, that's a good thing. But you should work under the premise that that's not going to be the way it was 2 years ago, where you wrote a check and then you went off, and 6 months later, and some big brand name firm wrote the next check, and then 6 months later, some big brand name late stage firm wrote the next check, and the machinery just kind of worked really, really, really well for fundraising. You should assume it's all clogged up. The plumbing system is not working very well, and in that scenario, you've got to figure out how to deal with kind of a scenario where that capital is not very easy to get. And I would say this is all true, except for like the super hot sector of the day, and the super hot sector of today is generative AI. So I think all bets are off on generative AI. Lots of funding, like lots of valuations that are being done, at pandemic levels. Really, really aggressive, big funding rounds. And I would also say, I just came back from a trip in San Francisco. I would say, in the Bay Area, I don't think it's as much doom and gloom. I think there's a lag between these two markets, and it's usually about a 6-month lag. I feel like the machinery is now starting to come into place in the Bay Area, which means that maybe as early as like the beginning of next year, the machinery should come back into place in Europe, but it won't be the same as it was during the pandemic. So it won't be as easy. So I think working off the assumption that it's not going to be easy is a much easier way to live than working off the assumption it's going to be easy and then being disappointed.
Yeah. And in terms of, we've obviously seen lots of companies that have failed to do that, like VanMoof, the e-bike company, went bankrupt. Babylon, one of your portfolio companies that listed, then ended up delisting and selling off bits of its business and shutting down some bits of the business. Lots of the speedy grocery companies that like the epitome of the pandemic hype have gone away. Is this the start of like a big wave of insolvencies, or do you think they're all very consumer facing businesses? Is it going to affect some sectors more than others? What do you reckon that's going to look like?
I think and the challenge with all of those businesses is the commonality among all of them were they were burning cash. And if you're going to burn cash, you need to have money in the bank to support the cash burn. And if you don't have money in the bank, you go out of business, right? These businesses didn't necessarily fail because they didn't get product out the door. VanMoof had a product, Babylon had a product. They didn't fail because the businesses were not making money on the top line. Babylon was a 900 million a year business, but they were burning money on the bottom line, and they didn't have the balance sheets to kind of support them. I think we're going to, and in a world where what I just said is the system is clogged up, money isn't being released into the system, and in some of these cases they made it more difficult to release. Like it's really hard to finance a company in the public markets post SPAC. Like there's some intrinsic disadvantages to being a public market company when you're burning cash that way. It is not easy to get the cash, and as a result, you end up losing, right? And so I think we're probably going to see more of this stuff. Like I have seen, there's a company right now that's that's hemorrhaging cash and is like desperately trying to do a convertible note to kind of keep itself alive, but $400 million has gone into the company, and like it's trying to go through the process of turning around. I wish them the best, and I hope they are able to turn around. But if they don't get that money in the bank, it's gonna hit a wall, and that's gonna happen with a few of these businesses. I'm older than I look, but back in the day in the dot-com bubble, there was a really nice website, and it was a doom and gloom website, so it probably wasn't that nice, but it was called Ept Company, and every day you logged on to Ept Company to see which company in the Bay Area was going to be failing in the dot-com economy, and they were really good at like breaking these like tips, and like you could literally like over the course of a year see the economy collapse, right, of all these companies that had really high valuations, had no real business models, which is a little bit different than today, and we're running out of cash. And then employees, et cetera, would like post up on the site, it was like a board almost. And there was a famous editor, Pud, who had it. We're kind of at that, if the company decided it wanted to set up again, like there'd probably be a market for that.
For a company it's just not going to raise that money, how much are those companies going to be able to sell themselves? Or
I think that's I think it's tough because I think it's, this is not just limited to the private market companies. The public market companies are also in a bit of hurt. People have been cutting back. And even the big companies that have actually rebounded in the public markets, like the Facebooks and the Googles, they all have hiring freezes right now. And the challenge with hiring freezes is if you're a small company and it's not working, in the old days, you could park yourself into a big company. The big company would aqua hire you, right? That was the expression. It was like kind of almost as much of a talent acquisition as it was a company acquisition. And if you have a hiring freeze, you can't not hire employees or potential employees and go hire people via an acquisition route and make them millionaires. Like it just doesn't make sense. And we've seen this firsthand. There's a portfolio company who was super strategic to one of the big companies in the space that's building in the metaverse. They really wanted to have it, have this company and what it's built and the capabilities of this team. And the VP really wanted to do this, but like corp dev is saying no, and like the CEO says, the whole infrastructure says no, you can't go make an acquisition because you want talented people, because we have a hiring freeze in the company and we're going to respect the hiring freeze. So I think the path towards the big companies like the Googles, the Facebooks, et cetera, are kind of closed off. And then there's a little bit of M&A in the smaller in the other companies. Like if you're building a product that like totally fits into someone else's product and you get to sell it, yes, you can get that acquisition done. But if it's a little bit more strategic, and it's going to burn cash. And if you're a business that's burning cash, which a lot of these businesses are, that's the reason why they have to even think about an acquisition. The buyer want to buy the business of a business that's going to cost them more money because they're going to have to patch up the hole of the burning of the cash. Probably not, right? And so again, if you want to be acquired, you're almost better off becoming profitable. You may end up becoming smaller, but then you're an asset and then you could actually sell off. And then it can't be a talent type acquisition, it has to be a product type acquisition. So the whole system gets gummed up. And by the way, this is when I said the analogy to the dot-com bubble and the dot-com collapse. The whole system got gummed up in the dot-com collapse. And it took like five, people forget, like 2000, 2001 is when the kind of the bubble burst. And, it wasn't until like the rise of mobile, social, local in 2005, 2006, 2007. And it really didn't get going until the iPhone kind of came out in 7, and then the App Store came out in kind of 8. So it took, 2000 to 2007, 2001 to 2008, like 7 years for this economy to kind of come back to where we were like super enthusiastic again as investors.
Okay, so
I don't think it's gonna be 7 years or 8 years. Like I'm just on the record. I think it's gonna be like 2 to 3 years.
But if anyone who's still feeling a bit depressed about that, I've got a question from Kevin Flanagan. Thank you, Kevin, who's asking, so apart from generative AI, what areas are kind of hot at the moment? What is attractive to investors, those investors who are writing the checks?
I think right now it is predominantly generative AI. I don't think there's other stuff. I mean, I think there was a bit of a boom around crypto, but again, that kind of changed as well. So all the Web3 stuff, I think, is a little bit more on ice today than it was before. I would say long term, there's a lot of value in kind of this computational bio and life sciences, but it's still a bit of a niche field, and it's a niche set of investors who are doing it. So I don't think there's like a big euphoria around that, but everyone is looking at generative AI. So I think that is. I wish there were like 5 markets, but like if you could position yourself as an AI company, we see lots of companies talk about themselves as AI now with LLMs, and even if they're really not, that's kind of the new big thing.
I spoke to a journalist, actually another publication, but kudos to him, who said he'd done a search of company names registered in the last, I don't know however long, and it was like an enormous uptick in company names that had AI in the title. So if you can squeeze that in, sounds like it's a good move at the moment. A question that Colin Mason shared beforehand: what's going on at the angel investing stage? That's obviously something you're just a bit upstream of. Have angels also slowed down, or what are the dynamics of reasons for or not investing as an angel?
Yeah, I think what we've seen is like kind of the way this is all played out is in early 2022, we saw the late stage firms kind of take a break. And that happened like pretty early in the beginning of last year. And then it kind of trickled down to the mid stage and the early stage firms like the Series A, Series B type firms. But seed was continued to be vibrant. And you saw lots of seed stuff in 2022 and in the first half of this year. I think seed has now realized the system is gummed up on the back end. And so they've slowed down. I haven't seen that as much from the angels. A lot of the angels that we saw especially in Europe, were like selling out of their positions in the subsequent rounds. So they didn't have liquidity problems. So like, they'd write the first check, it'd go off and raise a C, and then go off and raise a Series A, and there'd be a secondary of some kind, and they could actually sell it and kind of get 20x back for their first 50K, and they could kind of write a whole new set of 50K checks. You know, I think again, those are not happening anymore. So at some point, the system comes down to them as well. And you saw a lot of people who had made a lot of wealth in kind of investing in the tech economy, or they were tech founders, and they were deploying capital. I think when the system stays gummed up like this, it eventually trickles down. And then even, the very beginning, which is not that affected, gets affected because again, their liquidity kind of dries up. If I'm right that there's signs of life this side of the year in California, maybe there'll be signs of life again. Maybe it will never affect them nearly as much as it affects the Series A firms or the Series B firms. So TBD. We're still seeing angels actually quite a bit. We're still seeing a bunch of like people who have made a bunch of money doing all kinds of tech things, investing and looking at stuff. So I haven't seen the slowdown is not nearly as pronounced, but may end up getting pronounced with those sets of folks is kind of my guess.
Interesting. And then I've got a few people, I've got George and Kendra asking about climate tech. Like, do people not love climate tech as well? They're not signs of hope in climate tech.
They do. I should probably say like all the general impact stuff, and I think out of all the impact stuff, climate is probably the most advanced. There is actually some real enthusiasm for that. There is institutional appetite for that. That there are institutions that want to see this problem kind of get tackled because it is a known problem like that we all have to deal with as humanity. There are funds being set up. A new one got set up and it started in our office called Transition, which was founded by David Helgeson, who's founder of Unity, and his brother Ari, and then a whole bunch of people around them. So there is definite interest on the climate on the climate side and on the impact side, but I would say it is still more of a niche. I would say it is not every single fund that is looking at this stuff where it feels like every single fund is looking at generative AI. So, that's kind of the difference between the two.
Interesting. And then keep
But
the questions coming, people. You're asking good ones from Sebastian, which is, what's deal flow quality like? Like, what kinds of people are starting companies at the moment? Is it better because it's harder and therefore only people who really know their onions are starting businesses, or are people getting laid off and they're like, fuck it, I might as well try and start a company then?
all of the above, but I would say generally speaking, the quality bar for entrepreneurs has been up and to the right, like consistently since like 2015. So you just have to remember there are a lot more trained people in this economy than there were like 10 years ago or even 5 years ago. Like we were a very niche economy in the UK, and we are less of a niche economy in the UK. And there's a whole bunch of people who've learned a lot of the right lessons working and maybe a lot of the wrong lessons, but they know that they're the wrong lessons, in the last 5 years. And they're going off and starting companies. And so and the tech economy is not diminished, like it's actually got bigger. Like we use more tech services today than we did like 5 years ago. So there are a lot more people who see opportunity, including people who historically wouldn't have seen this kind of stuff. So like for instance, we did a legal tech company with a lawyer who teamed up with the professor at Oxford and a postdoc at Oxford, but the lawyer is not a tech guy, but the lawyer sees where the tech could go, and that business is like flying. So like it is. So we're seeing more people enter the economy as tech just touches a lot of other stuff. So I would say generally speaking, quality bar is up and is much more up and to the right. As an investor, you have to be a little bit vigilant about these things. There are a bunch of people who can't get jobs right now. So, the alternative to getting jobs is you found a company. That's not necessarily a bad thing. I mean, the Zoom guys couldn't be employed and set up a business. There's so many examples of WhatsApp folks like interviewed at Yahoo, like Yahoo of all places. They couldn't get a job at Yahoo. And so they ended up building WhatsApp because there were like no jobs available. This is like in 2000, 2008, the early days of like the iPhone, maybe in 2009, something like that. But, so being laid off is not a negative, but you do have to be vigilant about who it is that you're backing. But I would say, generally speaking, up into the right quality bar is actually not that's like the least of our problems as investors.
And on the talent front, have you seen? I've heard this from a few people, but not loads of people, so I'm not really sure whether I think it's true or not yet. But a few people have said to me that lots of these companies that were growing super fast, they hired some quite good C-suite people, and a big part of their comp package would have been options. Those options haven't really developed the value that those people hoped, and then so the kind of theory, and what we have seen a few people do this, is that those experienced C-suite will leave that Series C, D, whatever company and go and work for a much more established tech company where they get a much bigger base salary and their overall compensation is better. Are you seeing that happen? Do you think that is going to happen more?
Yes and no. The no, because I don't think the big tech companies are hiring. So that only works when the big tech companies are actually on expansion streaks. I think Google's been on a hiring freeze for like a year plus now. Same for Meta. So like I just don't think it's necessarily more attractive. So we haven't seen that play out. We are pretty fortunate in the dot-com bubble, which is more in the US. There's this thing in the US called alternative minimum tax, and you can trigger AMT. So you have stock options. You haven't sold your stock options, but you're still taxed at the time that you're kind of getting them because it's a taxable event when you're exercising them. But you haven't actually sold them just yet. You've just exercised, and then you have to pay this huge bill. And we're seeing examples of that in California. We don't have any of that dumb, like boneheaded legislation in the UK thing, thankfully. And we've also seen some dumb things where people borrowed against their stock options, and then you're living life on the basis that your stock price is like $100 a share, and then your stock price goes to $1 a share, but you borrowed at 100 and spent and burned, but now you have to pay back the loan, and you're kind of screwed. We saw lots of these examples where people actually went bankrupt in the US in the dot-com bubble, including some pretty famous people, like high flattering because of these kinds of, we haven't seen, we haven't been in that kind of level of excess. So, dot-com bubble was like 10 times crazier than the pandemic. So we haven't seen that, but you could see a lot of these kinds of things happen if people are not very prudent, but we haven't seen these. We've definitely seen companies hire a ton of execs. We have definitely seen a lot of the burn rate go to very senior people. We have seen people cut back on that because it's a cost center. Like, so if you're not performing, you got to figure out how to strip costs, and it's easier to get rid of someone who's like costing you 400K versus someone who's costing you like 40K. But it's not like there's a big job market for the 400K hires because we're not in the best job market right now.
Yeah, interesting. Just a few very quick more questions. We can run over a tiny bit, people, so ask them if you've got them. But if you do need to run away, don't forget to check out the Sifted Summit lineup. Hussein's going to be there. A whole bunch of other amazing founders and VCs are going to be there, and all of the Sifted journalists, literally all of them. So please come along to meet us. Matt Gaisley from, I assume, Silicon Valley Bank. Do you think there'll be a rise in exits via M&A with corporates? Like, is that an option? Are the corporates buying at least?
No, but that was the same question that I had. I think that a lot of these acquisitions are going to be more like for the smaller companies. If you can get the companies to profitability, there may be private equity firms that kind of roll these things up into bigger entities. I just think unless you're buying a business versus buying a technology team, it's not that interesting for a lot of people. And then the business has to be strategically relevant to the corporate in order to pick it up. I don't think like Fortune 500 or FTSE 250 are going around. I mean, they probably should be, right, for all the reasons that people are bullish on generative AI, looking for these kinds of people. But I don't think the old fuddy-duddies are looking around for the new hot thing to kind of incorporate in, even though they may have like very stable balance sheets, et cetera. So it's just tough, right? Usually tech companies buy other tech companies, and the tech companies don't want to take on more losses right now.
Yeah. And from Phil Guest, what what are you assessing when you're investing in companies? Are there kind of new criteria you've added to make investments in this current climate?
No real new criteria. And our general view at Hoxton is we're trying to find new categories, so brand new products and services that are inventing new market categories, and we think the category is going to become really big, and we want to be an investor in them. And we think a lot of them are going to move to the U.S. or tackle the American market really early. All of that stuff exactly the same. We don't really care where the companies come from, but we do care about funding. So like the new lens is, we always used to have this paragraph in our investment memos, like, if the like who would be the funder of the company, if the company had to go back out into the markets and go raise money, because we're worried. We used to be really worried. Like we almost talked ourselves out of Deliveroo way back in the day because we're like, that business is going to need a lot of cash. We're living in London. There's not a lot of cash back then. Who the heck is going to fund this company, and how is this company ever going to scale if it doesn't actually get the money that it needs? And that really like weighed in on us and like made us a lot less aggressive at doing the Deliveroo round. And then Index ended up coming, and we ended up co-investing with Index, and kind of rest is history. The company did a fabulous job raising money, and went public, blah blah blah. And the concerns were not there, but those same concerns, which the last like 7-8 years we haven't had to worry about, we're much more worried about these days. Like, what happens if Index, XL, Sequoia, et cetera, is sitting out the market? Like, how is this company actually going to be able to scale? And that weighs a lot more on us. It's always been there in our criteria, but it's been less pronounced as a criteria because money was almost a given the last few years, and money is no longer a given these next few years.
Yeah, amazing. Okay, so maybe one final question, which is on the VC side of things from James. And sorry, Matt, I know your employer does have a different name now. I realized that as soon as I said it. James,
HSBC Innovation.
very good. Hussein knows. What does the fundraising picture look like on the VC side of things? Like, which LPs have pulled back? What LPs asking you for? Are they more needy? If I'm a wannabe VC, should I just also sit it out for a little bit longer, stay at McKinsey or wherever I am?
Yeah, I mean, I would say the family offices are probably still investing. The institutions, generally speaking, have this thing called a denominator effect, which is, they manage a big portfolio, they put the portfolio to work. And then when the overall portfolio comes down because the stock market has come down, then to be fair, the stock market has actually come up, like the S&P has rebounded this year. So, but, if you're investing, say, 5% of your assets into venture, it's usually closer to 2%. And then your denominator goes down, right? Your 2% of the denominator is a smaller number, and you find that you're over invested in venture. And venture is one of these things that's not liquid. It's not like you can cut relationships because you're stuck with them for like 10 years, so you've got to figure out. So many investors are cutting back their relationships on their funds that they're investing into. So if they've invested in 20 funds, they're going to slowly get that down to 15 funds or to 12 funds. And that's generally what's happening. The counter to this is not everyone was as exposed to tech. So people want to still be exposed to tech, and they realize tech is a huge part of the economy and should be a huge part of the economy. So the skepticism that was there in the .com when people were like saying, hey, this is all theoretical, like we can turn these things into businesses, that, but it was theoretical. It's not theoretical anymore. It's like real, like, there are reasons for why AI will disrupt some of the old world economies. People understand that they want to be shareholders in the new stuff. So it kind of, there's positives and negatives. I would say it is less easy to raise than it was like 2 years ago, just the nature of everything. And I'm really curious to see how easy or hard it's going to be for new funds. I can see like if you've proven yourself and like you've actually turned not just things into paper wealth, but actual real wealth, like you've given money back to people, why, it may still be troublesome to raise, but like why you would raise. But I'm really curious to see what happens with kind of what the industry has been termed the zero interest rate phenomenon funds, right? That people raised a ton of money when interest rates are low and then put it to work in high momentum deals, and whether they'll raise more money or not. And what's going to happen with, there's so many emerging managers, right? What's going to happen with them as well.
Amazing. Right, we'll end it there, but thank you everyone for joining. We'll be doing a little write-up of this, which will go live on the Sifted website soon-ish. If you want to see any extra notes, please come to more Sifted events, come to the Sifted Summit, sign up to all our newsletters, etc. We have one that comes out on Fridays, written by me and my colleague Eleanor, our deputy editor, called Up Round. all about venture capital. So if you are as interested as Hussein and I in the sector, please sign up. And that's it. Thank you very much for coming.